All right, good afternoon. Welcome to another Wall Street Wednesday. Today is March 24th, 2021, and this is, let's see, in the series, this is number 42. So welcome. Welcome, guys. And as I start this off, as you guys join and I wait for other people to join, once again, my disclaimer that everything that I talk about on this show is basically my opinion. If you find something that you like or you want to trade, make sure that you speak with your financial advisor and get some advice before you go in. And that's really good advice. I don't want you losing money, and I don't want you trading or doing anything that you don't truly understand. So that's my disclaimer. What's going on, Bobby? What's going on, Alex? Let's see who else is here. I'm not sure who that is. So I haven't, I stuttered, I apologize. So the one benefit is I try to get to know everyone that comes onto my Wall Street Wednesday. And when I recognize the names, I try and, say hello, how you doing? So just want to check on people. I see twins here. For those who don't know, Twin and I went to college together, so that's how far back we go. I can't speak for Twin, but I was basically, easily 100 pounds lighter then and didn't have a gray beard. But that's another story for Twin and I to talk about in the future. All right, so as I wait for people to join, I'll give it a few more minutes. This market, thank you. And by the way, I can honestly tell you, I can guarantee that the whole time that we were in college, that Twin never thought I'd be a college finance professor. I think he thought, I can almost guarantee that was the furthest thing from his mind as well as mine. I know it's true. So anyway, I'll give it a few more minutes just to have some people join. Things have been kind of interesting in this whole week and since I last spoke to you. Hey, Christian, how are you? So there's another one of my former students, Christian. So it's been a real interesting week. And the reason why I mean interesting is can't get a read on anything. There's basically been very little follow through. They've been forcing or jamming a whole bunch of these special situation, these SPACs into the marketplace. So it's been really, really, really interesting. The IPO calendar has been full, but most of them are special situations. And the other thing is a lot of the stocks that I follow that have come public on the IPOs, they have no follow through. Which what I mean by that is they're opening up higher and then basically trading down. So all the juice is on the opening, and then I had a few which I'll talk about today that could not even hold didn't even open up at their IPO price. So they opened at a significant loss. So it's been interesting. I'll talk about it again. So again, welcome guys, Wall Street Wednesday, Professor Milligan. Just one more time, a reminder, make sure you speak to your financial advisor on anything I talk about, anything I recommend. And the reason why I'm saying that now is because I'm going to talk about the commodities market, and several of the commodities that we have talked about over the past 2 or 3 weeks have broken out and started running. Now, I know whenever I talk to you about commodities, I always say to you guys that and nothing new here. I use the commitment to trade report. I go through it. I analyze it. That's on the fundamental side. And then for the technical side, real simple. I use a simple 10-day moving average. The reason being, again, is that the commitment to trade report comes out weekly. So one thing, first and foremost, it's a week behind. The second thing is the data is up until Tuesday of the previous week. So for argument's sake, all the data up until this Tuesday. So at the end of yesterday, market closed on Tuesday. They stopped collecting that data. They're compiling it and they'll release it this Friday. So I guess what I'm saying is the commitment to trade report, as good as it is not a short-term trading indicator. So, and now, don't get me wrong, I have some friends that use it, that I've taught how to use this and show this to, and they actually short-term trade on it. But the reason why I bring it up again is there's several commodities that are running. And the reason why I like the commodities market, and I'm going to talk about it a little bit today, don't get me wrong, I'm about making money. So I'll go in the commodities market, I'll go into the stock market. I've been in the bond market. Now, my area of expertise in the bonds is not where it used to be. In fact, my area of expertise when it comes to bonds came from the fact that I had some really, really smart brokers that understood the bond market a lot better than I did. And basically, they the ones who guided me through it, to be honest with you. So, and it's funny because they nicknamed me the Bond King, but I'm not the Bond King, especially with the last name Milligan, which kind of was close to Milken. All right, so with all that said, what I did was when I came up with the commitment to trade report, the other thing I did was I married with it a 10-day moving average. I had to try and figure out something that was going to indicate when this thing finally was going to turn and go in my direction. Now, the one thing about the commitment to trade report typically is it's not a short-term indicator. It's more of what I call a trend indicator. So it's confirming when trends are changing. So that's what I expect. So that's the reason why, like when I take my position in these, I typically look for a longer-term move. Now, don't get me wrong. You can get some short-term moves in and take your profit, but like all securities, like all investments, big moves take time. Big moves don't happen overnight. Of course, unless there's a short squeeze going on like we saw in GameStop or something to that effect. But in general, and by the way, if you want to see some short squeezes, go into the commodities market. You'll see some short squeezes. All right, so hey, hi, how are you? Good to see you. Let's see what else is on here. All right, so let me get down to a couple of things. Let me start with this. I had just posted that I was going to talk about my PRCSMM model again, my PRCSMM and what I use. So one of the things that is in PRCSMM, the second PRCSMM again is I can't type. I'm on the iPad. On my phone, my fingers are big. I can't type it. So my PRCSMM is capital P, capital R, capital C, S, M, M, PRCSMM. So today I'm going to discuss the R. And the R is reward to risk. Now this has always been a big thing for me. And I'm going to mention it right now, and I think it should be a big thing for you guys. And let me explain it this way. If I'm going to take one share, let's say $100 stock. If I'm going to buy $100 stock, it means I'm risking $100 because in theory, technically, hey Natalie, the stock could go to zero. So my risk is I buy $100 stock, my risk is I lose it all and it goes to zero. When I buy $100 stock, I'm not looking for $100 stock that I think has potential, that's going to go to $110 and make my 10% and go about my business. If I'm a short-term trader, yeah, I'm happy with that. But what's interesting is, and I've done this for a long time, and what changed me was I would buy stock at 100, I'd flip it out at 110, make my 10% on margin, make my 20%, a couple thousand shares, smile and say, wow, I made a couple grand a day and go out the door. And I was happy with that. Like all traders, and I'm telling you guys this, you should go back and analyze all your trades, the good ones and especially the bad ones. And the question you should ask yourself is, why did it work? Why didn't it work? Why did I close out my winning position so soon? Why didn't I close out my losing position sooner? Ask yourself the whys. And what I found for me was I was buying stocks at 100, flipping out at 110, walking around like I was the greatest trader that ever lived, only to look at the stock 6 months or a year later and see the stock trading close to $170, $180, $200. So that's when I started realizing I'm taking on a lot of risk, $100, for a reward of only 10%. And that's when I started switching my thinking from a risk reward to how much am I going to make if I'm right? And how much am I risking? So as I started doing that, I started changing my strategy a little bit. And that's what I put into PRCSMM. So let me explain what I mean by that. You find a company, you think the product is disruptive, you think the product and service is going to go to the next level. The question I'm going to ask you now is, if you invest in that company, what kind of return can you expect to make? Now, I'm going to pick on a few companies. I'm going to pick on Levi Strauss went public a couple of months ago. All right, jeans, IWAM, UM, really, good company, brand name. My question to you is, if you buy Levi Strauss, and I don't know where it's at now, but let's say it's $30. You buy Levi Strauss at $30 and you hold it for a year. How much upside do you think you'll get in that company? And my comment to you is, in a bull market, Levi Strauss might go from $30 to $40. All right, so you're basically talking about a 33% move, but that's in a really good market, bull market, with everything going well for Levi Strauss. And the reason why I say that is there's not much upside potential. So your reward for taking on that risk of buying that stock is not there. Now, I just had a brain freeze, but There's another company I was going to bring up, same thing. Oh, Reynolds Wrap. They came public. Great company, great products. We all use it. We know it. Tradition brand. It's growing. It's doing well. But if you buy that stock, are you going to see your money double in 6 to 12 months? And most likely the answer is no. So as you start to look at these companies and you start to invest in them, okay, they got a disruptive product. The next question is the market going to be big enough? Is the potential big enough for this stock to actually double? Again, I'm not taking the risk of buying these companies to make a 5 or 10% rate of return. All right. I'm managing my portfolio. If I want to make 5 or 10% return, I can just buy the S&P 500 ETF, or I can hire a broker who doesn't want to take any more risk and say, here, manage this money, and I'm happy with 10 or 15%. I took control of my account because I want to make more, and I got tired of hearing Wall Street say, or how can I put this? And I got to be polite about this, of hearing wealth managers say that, wow, you made 20% on that trade, that's on your portfolio, that's a really great rate of return. It is if you're actually following modern portfolio theory. If you're actively trading and you understand what I do about how to manage risk and handle risk, you want to go and you want to go big. You want to go bigger. Now, part of handling that risk and managing that risk also is knowing how to hedge your account, knowing how to hedge your trades, and also knowing how to when to get in and when to get out. So these are things that you have to figure out. And that's some of the things I'm talking to you about. All right. One last thing on this. In terms of risk reward, one of the things I had posted a couple of months ago, and it's on the my YouTube channel, and that is I talked about a hedged synthetic. And I spent about an hour and a half yesterday with one of my former students who's active in the commodities market about a hedged synthetic. And when the light bulb went off and clicked, he said, oh my goodness, I'm paraphrasing because he didn't say, oh my goodness, but you get the idea. So, oh my goodness, Professor. He goes, I said, I haven't been this excited in I don't know how long. He goes, this is really exciting what you just showed me. And I said to him, this is when you understand how to use derivatives and you understand how to hedge those positions, then you really open up the floodgates and you see now how you can make a 100, 200, 300% return on your money. Now, with that said, I'm going to use that to piggyback right into commodities. I'm going to talk about that real quick. All right. Just a reminder again, before I do that, these are my opinions. These are my thoughts. If you like what I'm saying or you decide that you want to look at it a little further, please discuss it with your wealth manager, someone who's legally licensed to talk about this. I do not want to be sued. I'm not looking to be Reddit or anybody else. So I'll tell you what I like. I'll tell you why I like it. And I'll let you decide from there to speak with your wealth manager if you want to do it. Now, this is going to take a couple of minutes, and I'll tell you why. Because I'm not only going to tell you which ones I like fundamentally, I'm going to tell you which ones have actually broke the 10-day moving average and actually are confirming what we already saw. So, on the long side, if you went long the dollar like we talked about a couple of weeks ago, stay long the dollar. All right? Stay long. Now, just to give you a little idea what's going on, and I talk about this, the commercials were net long the dollar, percentage they've owned in a long time. All right, so let me say it again. The commercials were net long the dollar. All right, they were bullish. And as the dollar went down, they used that to actually buy more and more dollars. And the speculators were net short, and the reason why they were net short is they kept adding to their position as the dollar was falling. Well, the dollar started to rise, and you're seeing them now start to close out their positions, and the commercials that were huge net long are still huge net long, but they're closing out their position, they're taking profits. So what that means is stay long the dollar. It's broken above the 10-day moving average for several days. It's trading really well. If you got long, stay long. If you're getting long now my indicators are not giving me the same buy signal. So when I tell you about the buy signal and I tell you about the 10-day moving average, that's when you got to get in. All right. Next after that, so that's what else? The 30-year Treasury bond, stay long. It's running, stay long. Now, For those who don't understand bonds, it's kind of interesting because as the 30-year Treasury runs up in price, it means the yields are dropping, which is kind of interesting in this environment. But again, stay long. Now, part of that could be the fact that inflation is not a big worry. All right. But again, the 30-year Treasury, not only stay long. If you actually got it in the commodities market, stay long. What else? Gold. Gold. Stay long. Gold is starting to turn. Gold is going well again. Other ones I've gotten fundamentals, but the technicals have not supported yet. Believe it or not, is the yen. Japanese yen looks like it's a nice long. Wait for it to move above that 10-day moving average, and once it does, I'd be all over it. Okay, that's all my longs. Not too many longs. Oh, and I did mention the Mexican pesos. Mexican pesos. Now, it's funny because I was discussing this with my student yesterday, and I told him, I said, look, I got a buy recommendation of Mexican pesos about a year ago. It's about around a year ago. I said, I looked at it and I said, and please don't take this the wrong way. I'm going, I just can't buy the Mexican pesos. And the reason for that was I'm looking at the economy. I know the problems that Mexico's having. I'm going, really, is that currency going to run? And I couldn't figure out what would make that currency run. So it was me. I couldn't lock into it. Well, it took off and it ran. And I'm getting that same buy signal, fundamental buy signal again. So all I'm saying to you guys, and I'm pulling up the Mexican pesos now. I just want to take a look at it. Make sure I'm in the right market. The Mexican pesos is, yeah, it's below its 10-day moving average. The price is down significantly from where it was beginning of the year. So it looks like this is, it looks like we're looking for a reversal. It did make a little run a couple of weeks ago. But again, I would go, when it breaks above the 10-day moving average, I would look to go long the Mexican pesos. Now on the short side, these things are already running. All right, interesting. Lean hogs, not for the short. Lean hogs is running to the upside. It looks like lean hogs is in a short squeeze. And the reason why I mention that is the meats, the softs, lean hogs, live cattle, and feeder cattle. I've seen more short squeezes in those markets than I've seen any place else. So they're thinly traded. And when somebody gets on the wrong side and they end up getting squeezed, I mean, they just squeeze them. So the way lean hogs is running right now, I wouldn't be surprised if there was a short squeeze in the way that's running. Once that thing breaks below its 10-day moving average, I get short. Already moving down. The ultra 10-year Treasury. Now I'm laughing because the 30-year is moving up in price. The 10-year is moving down in price. What we're looking at is a flattening of the yield curve. Hopefully we don't go inverted, but we're looking at a flattening of the yield curve. That's what the commitment of trade report and the commercials are telling us. Again, I hope I'm not going over too many people's heads here. But and let me add this. The reason why I love the commodities market, there's always something in a bull market and there's always something in a bear market. So those of you who like to trade in things that are going higher, with all the different commodities, there's always something that's trading upward in a bullish market. And there's always something that's in a bearish market. So just food for thought. Who else? Natural gas, stay long. Short. Stay short. If you're short, stay short. Cotton, stay short. If you're short, stay short. They're breaking down. Coffee, stay short. Sugar, stay short. Currency-wise, the Australian dollar, stay short. The New Zealand dollar, stay short. All of these are already broken below their 10-day moving average, and that's the reason why I said stay short. If you're short, stay short. You're going to see some nice moves. What else looks really? Spring wheat. Spring wheat fundamentally is there. It hasn't broken down yet, but it's when it goes, it's going to go. Spring wheat. The other one is corn. And that's my list. So let me read them all. Well, I'm not going to read it all over again. I apologize. It's just too much. I don't want to read it all over again. So that's what's going on there. That's my opinion on the commodities. I think there's some money to be made there. Some things are confirming themselves. For those of you who understand how to do a hedge synthetic, maybe that could be the option. Now, one of the things with a hedge synthetic when it comes to trading commodities, one of the reasons why you're doing a hedge synthetic is to lower your cost on the call or on the put that's going to make you money. So for argument's sake, if I'm bullish gold, the reason why I would use a hedge synthetic is to reduce my cost on that call option. All right, that's what I would do. Now the problem is this: if you put together your hedge synthetics and look at it, and once you do that, the price of what you're paying for the call is not cheaper. In other words, just buying the straight call is cheaper than just go long the straight call. The hedge synthetic is put together to help you buy more time and lower your cost in buying more time. If you can't buy more time, or your cost is not cheaper than just basically going long the call, then just straight go long the call. All right, that's what I really want you to understand. Ham, I will look at this in a minute. Just give me a second. I want to finish up with this commodities, and I got something else to talk about. All right, I'll check out the FER and I'll look at it. I'll take a quick look at it, Ham, and I'll put it on the recording. It'll be on the recording. All right, now, let me get my pad. All right, so we got the commodities, we got that. Now, let me talk about some other things. For the last couple of weeks, and it happened today, the number of stocks setting 52-week new lows as opposed to 52-week highs, the lows have been outpacing the highs 2-to-1, 3-to-1. Today it was actually 3-to-1. When you look at all the NASDAQ, you look at NASDAQ, New York Stock Exchange, and Amex, you had 3 times as many stocks setting new lows as you had stocks setting new highs. The reason why I bring this up is what I'm telling you is be very cautious now. All right. When you have fewer stocks setting new highs and more stocks setting new lows, basically that means you're in a flat market or maybe even a bearish market. Now, I'm not saying we're in a down. I'm not saying that the market's going down. I'm just saying that whatever driving these stocks and driving these markets, these stocks are not keeping up. And if you look at your own portfolio, you know what I'm talking about. I would guarantee that almost everyone that's on this call right now, when they look at their portfolio is lower than where it was a month ago, 2 months ago. All right. So one of the things I look at is the number of number of stocks setting 52-week highs, the number of stocks setting new highs, and also the number of stocks setting new lows and 52-week lows. Alex, my put credit spread has been getting destroyed. We'll talk about that in a minute. Give me a second, let me finish this. So what it's doing now is it's just really, the market is just all over the place. There's no follow through, and that's showing up in the IPO market. The IPOs are coming, they're coming rampant, they're coming hot and fast, and I talked about it, and I went back and looked, and I keep looking, and you guys know I track the IPO market, and almost every IPO that's come out in the last 2-3 weeks, all of them are down. I think there's 1 and 2 that actually are, when I say down, significantly down below where they were, their highs, and you have a number of them that actually have broken below their IPO price. Oscar Health comes to mind. Oscar Health was priced at 39, never even saw 39, opened up at 36, and the stock is set a new low today. You've got a bunch of these stocks that are just breaking down. I'm just looking at them right now. The one I thought would really do well or could do well was TUYA. I'm not sure how to pronounce it. Priced at 21, and guess what? It broke below 21, and it looks like it's in a downward trend. So my only point in saying all this to you guys is that one of the things that I use as a leading indicator is the IPO market. I look at the number of deals coming public. I also look at what they do in the aftermarket and how they trade. And the way these things are trading, they're trading flat, are not even trading flat, they're not holding up. So again, I would be cautious and just wait to the sideline. I also mentioned to you guys that I'm really not comfortable shorting stock right now. And it's a shame that what I'm about to say. And part of the discomfort's coming from the fact of I'm really worried about getting squeezed. I've been caught in short squeezes before. They're not fun. And right now, the way what's going on with GameStop and the rest of these stocks, I'm worried about a short squeeze again. Now, before I jump off of this, by the way, as you guys know, GameStop had a rally in it. It's pulled back. I laughed. I read an article, and some of you probably saw the article, where Bill Gross made, I think it was $10 million trading options on GameStop. So I'm going to say this, then I'm going to let it go. Understand this. When you go into the commodities market, when you go into the derivatives market, when you start trading options, you start trading derivatives, they are zero sum. What that means, it literally is, you're competing against me. You're competing against somebody else. You're competing against Bill Gross. All right? Do your homework. If you're competing against Bill Gross and you have no idea what you're doing, he will pick you off every day, all day. You know, there's a saying in the commodities market, futures market, options, derivatives market, there's a millionaire made every day. Understand this. If there's a millionaire made every day, the other side of that, because it's zero sum, that means that there's somebody that lost $1 million or a group that lost $1 million today. So when you think about, in this respect, about zero sum, for those of you who don't understand zero sum is like going to Las Vegas and putting your money on, in gambling. It's zero sum. The house, if you lose, didn't make any money. They just took your money from you, left you and went to them. If you won and made money, you didn't create any wealth. You just took money from the casino and put it in your pocket. Zero sum. Make sure you understand that. This is not, when it comes to derivatives, it's not a game to play if you don't understand it. With that said, I'm actually working on a master's class on derivatives. I actually am sitting here writing it up now, putting that together. Please don't rush me. It's a lot of detail going into it. Make sure that you guys understand. It's not even strategy, it's just basically understanding. I can't tell you how many times I've spoken to clients who've had option positions on it, thought they were bullish or long, and they ended up being short, or thought they were short and ended up being long. They had no idea what they were doing. So, and my job is to straighten them out. So I'm going to do my best to help you guys with some classes on derivatives and how to trade them and how to make some money. Again, all right. Now, with that said, I covered that. Let me see real quick. Best game in the world. You win or you lose. You have to know it. Yeah, thank you, Christian. Christian's right. Please read his comment. And now, Alex, I believe it's Alex Alexa Latour. I'm looking at your name. So you talked about your credit spread. Can you give us a little more detail? Can you type in what you actually were doing so I can take a look at it if possible? While you're doing that, Arham asked me a question on FVRR. So let me pull up that chart. And I know that stock, FVR, I know the stock has come under pressure like a lot of tech stocks over the last couple of weeks. So I'm not surprised in that respect. So let's see. And for those of you who aren't into technical analysis like I am, the one thing I would say is, which I'm doing now, anytime you look at a chart, switch it to a weekly chart. The reason being, a weekly chart can give you more, what's the word I want to say? It takes out the volatility. It smooths things out so you can really see what a stock is doing. And when you go short, the shorter the time, the more volatility is going to show up. So I go to a weekly chart just to see. And right now, as I look at this, it looks to me like, no, hold on, so let me expand this. FVRR has moved down to the bottom of its trading range. There's a trading range right around, it looks like the 200, 195 in that range, somewhere around there. And it's moved all the way back down into that trading range. So it's kind of doing what the rest of the tech stocks are doing. I'm looking at it now. I'm going to a daily chart to see if I can narrow this down a little bit. And as I go to a daily chart and I narrow this down, there's no question that the stock is trading right at support. Support is right here at 200 and change where it's at. You're hitting on support. You need it to hold this. If it doesn't hold support here, your next stop could be as low as 145. 145. Richard, how you doing? So that's where your support is. If it does break through this area where it's at, if it holds and breaks through resistance, you're going to have some traffic up here at 225. If it breaks through 225, you got more traffic at 250. This stock's going to have a lot of work ahead of it to get through these numbers. It's going to need some type of catalyst, probably some type of news or some type of corporate event that could actually help it. All right. Any other stocks you guys want me to look at? Boom. I'm still waiting for Alex. If you can tell me more about your credit spread, what you did. And did you write it or did you buy it? And again, a lot has to do with, if you're writing it, versus buying it, it depends. If you brought the credit spread, and what I mean by if you brought it, if you brought the, if in other words, if you're bullish or bearish, the credit spread, that will have a lot. So, but it's a put credit spread. So you brought I assume you brought a put credit spread, and I'm not sure what the underlying asset was. One other thing I'm going to say, and I do mainly bullish put credit spreads. I opened my position before everything started tanking. Okay, yeah. The good news about that, though, is that if it's a true credit spread, that you could minimize your loss. And what I mean by that is, you're short one put, you're long another. You're looking to collect premiums. So most you can lose is the spread between the two, plus whatever the VIG was. So that's not as bad as being naked. So that's the good news. That's if there's good news. I hate to put it that way, but that's the good news. All right, I lost my train of thought. There was something else I was going to tell you guys. It happens to me a lot because my mind works faster than my mouth can function. That's just who I am. Let's see, we talked about that. There was something else I was going to tell you guys, and I cannot remember. Let's see. So you have positions in AMD, Tesla, PayPal, Amazon, etc. Yeah, I understand. This market right now is pretty much topped out. Near term, it's going to be interesting to see. I think it should hold. I think it's going to hold. That's just I'm the long-term bull. All right, cool. So you have some time. And you're out of money. So that's the main thing. Time is, when it comes to derivatives, time is always your friend. Anytime you can put time on your side, it's going to work to your advantage. Whether you're right or even when you're wrong, if you have time on your side and you're wrong, there's things you can do to minimize your loss. There's things that might happen where you might get a short-term bounce. On the commodities market, as most of you know, there's contract rolls. And so in those future contract rolls, you can get a bounce. Even if the thing's actually in a bearish and been bearish for the last couple of months, on a contract roll is this. If let's say you're short the US dollar, all right, and the contract's about to expire, and you want to stay short the dollar. The only way you can stay short then is you're going to have to close out that position that you're short, which means you're going to have to buy it, and then roll that money into the new short position or the new contract. All right. Now, the other thing that happens is the exchange itself, the commodities exchange, wherever you're trading, they decide when they're going to roll the actual contracts. All right. They might do it because they roll contracts themselves. They typically won't tell you because they know that when the contracts are being rolled, that there's typically going to be a spike in the price and spike in volume. All right. So you'll see that. So one of the things that happens is like with commodities, you might get a little pop in your derivatives because of contract rolls, and that would be a good chance to take your profit and cut your loss and move out. So again, when you look at the charts of some of the commodities, you'll notice the contract rolls. And on contract rolls, I'll tell you, contract roll, you'll see the volume spike, you'll see the price probably spike, and then it continues to do whatever it's going to do after that. Let's see. AMD's down, and it's interesting. For those of you who follow the text, the AMD being down, Advanced Micro Devices down, also Intel's down. And one of the main reasons why the chip manufacturers are down is because their major clients who basically were buying chips, Apple comes to mind, has decided that instead of them buying chips, they're going to actually manufacture their own chips. They're going to be the OMEs for their own devices now. And so what that means is Intel and AMD have lost some major customers, and Apple's not the only one that's doing that and talking about that. So because of that, that's the pressure that the chip manufacturers are coming under. Interesting. I don't know. In other words, I guess I'm saying I don't know if that's going to help AMD bounce back because that news has come out. It's being discussed. Intel swears they have a new chip that is going to do that, but the challenge with Intel, and Intel's been on the news all day talking about it, but the challenge with Intel's new chip again is that one of their biggest customers, Apple, if they're going to manufacture their own chip, but they said they are, and they're starting the process to build the factories to manufacture their own chip. If they're manufacturing their own chip, why are they going to actually buy Intel's? Intel's chip's going to have to be a lot better than theirs for them to do that. So just a little food for thought. One of the things, guys, that you always want to do is you want to be avid readers about the markets and listen. It only helps your trading. All right, I did see something else in here someone was asking about, and I don't see it anymore. All right, so I don't see that. I'm just looking again. Oh, let me mention this. On the IPOs, when an IPO, say it again, when an IPO breaks its IPO offering price, I'm going to pick on Oscar for a minute. Oscar was priced at 39. It never, ever, ever, thank you, Lance, too. Plus, you guys know that the Suez Canal is being blocked by a tanker. So it's disrupting all the chains. It was all over the news this morning. It's turned sideways. It's blocking. Nothing can get in and get out. It's really going to hurt supply chain. Thanks for mentioning that, Lance. Yeah, pretty interesting. But going back to Oscar. Oscar was priced at 39, opened at 36, and every other day it's setting a new low. What else? There's another one. Finch Therapeutic, Connect Bio. Those stocks IPO'd and they broke below. They broke. Tuya, Tuya. I thought it was going to do well. It had all the signs. It was priced at 21. It's broke. They all break into the downside. So just be careful. Now, you had a couple of deals come public today. DigitalOcean, AVC auction was a used car auction. DigitalOcean was priced at 47. Stock opened up at 44. I'm not sure where it closed at today. DigitalOcean. Symbol's DOCN. So stock was priced at 47, opened up at 42.50. It looks like. Oh, I take that back. Opened up at $41 off of 47 pricing. Follow me now. Went as high as 45, but never got to 47. This is a deal that's in trouble. As you guys know how I talk about deals in trouble. This is a deal that's in trouble. And by the way, winner's low today is 39. So if you're long that stock, if you're trading that stock, if you're looking at that stock, you know, this is Milligan now. Anytime a stock does not open up at its offering price and trade higher, you want to get short. Now, it's probably going to be a problem finding the stock to get short. Check and see if there's options. There should be options now on Oscar Health, but check and see if there's options. Keep an eye on it. It's one that you want to check. The AVC auction was priced at 25, opened up and traded as high as 32. Again, I'm not, and the symbol's what? AVCA. And that stock, oh, I was wrong. I thought it was AVCA. AVC auction, right? AVC auction. AVC auction. All right, I got to go somewhere else and find it. Let's see. Hold on a second. I'll get the price. Symbol here. Bear with me a second. ACVA. I had it backwards. ACVA. ACVA. And AVCA again was priced at 25. Been as high as 34. Closed the day at 31.25. So, you know, keep an eye on it. You already know the number. If this thing breaks 25, it's a short. I'm going to tell you right now, if it breaks 29, which was the intraday low today, if it breaks 29, it's probably going to charge the 25. That's just, you can put that down as a Milliganism. All right. When an IPO, the first day of trading, it sets its low for that day. If it breaks that low again, 2 or 3 days later, it's probably going to be a good short. This is me. And you probably, if it breaks that 29, and by the way, it could happen tomorrow, could happen a week from now. When it breaks that 29, it's going to test 25. All right. That's typically what happens. Understand again, the investment bankers are there. They're trying to hold this thing up. But once it, but then they stepped away now. And once it breaks that 29, trust me, selling will come in and test that 25. Done these a number of times, seen them a number of times. Trust me on this one. All right. Yes, I did. Let's see what else. Anything else? No, I don't see anything else. So let me just do another little FYI for you guys. I am diligently working on master classes. I am diligently working. Putting together the actual class itself, just like I do online, at the university, putting together the class. I'm right now, I think I found, and I hate to use the word expert, but I think I found someone that's probably one of the most knowledgeable people I know in the cryptocurrencies. And I'm in discussions with him about creating basically an online class that will help teach about cryptocurrencies. I will not teach anything that I talk about anything that I don't have an understanding. I learned how to stay in my lane. And so the goal is to educate people, help people learn more about a particular asset class, not for me to guess or try and give you bad information. Bad information is dangerous because you'll lose money on bad information. So I want to bring somebody in that understands the cryptos, really knows what he's talking about, and have him talk to you guys about cryptos and how they work and how to trade them. The guy's quote unquote an expert. The guy trades the cryptos and he's been banking money in the cryptos for a long time. So hopefully I can get him on. And as I mentioned to you, I'm working on a class right now on options. I've put together a PowerPoint, a presentation on shorts and margin and short squeezes. So we're putting this all together, me and my partners, and I'm excited about it. And the whole education component. My belief is that most people are not educated enough to actually consistently make money in the market. My old saying, in order to make money in the market, you need to know the rules of the game. And these classes will help you understand and learn the rules, which will hopefully make you a better trader. All right. I'm going through all that. I don't have anything else to add today. So if you have something that you want to, if you have a stock you want me to look at right now, or you have a chart or something you want to ask me, now's the time to do it. Okay, Christian, snow. I know you like falling knives, but what's your take on snowfall? Snowflake. Snowfall's the TV series, right? Woo. Wow. I got to confess, I have not really looked at this in a while. And the reason being is because I know it's in a downward trend. And so for you guys, one of the things happen with me is that when I have a lot of stocks I'm trying to track, I don't look at them every day. I put them on my alert and they alert me when they set new highs or new lows. And snowfall looks like it's right there at its new low. So I'm on a weekly chart, by the way, right now, Christian. So here's the deal. No question. Snowfall is right at $208. I'm not sure. I got to go back and Christian, maybe what was Snowfall priced at? What was the IPO price? And the reason why I mentioned to you guys is if this thing does break its IPO price, if it already did, but when it breaks its IPO price, it's going to get hammered again. It's going to come in. The other thing too is I wonder when the lockup period's over on the stock. I can look that up. I'll look that up later on today. So, but right now the stock is closed at $208.60. I'm looking at a weekly chart. Nothing to see there. I'm going back to a daily chart now. Let me zoom in so I can see more of this data. And yeah, guys, I know, Christian, you've been short the stock for a while. I'm here to tell you again that this stock is going to, I don't see any reason why. You're sitting at major, there's no, I'm stuttering now. There's really no support here at 208. There's no support here. It's been down here before, maybe about a week or 2 weeks after it went public. It stayed down there for a day and then bounced right back from there. And today it hit right back almost to that same low spot. I'm going to say to you right now that, again, talk to your advisor, speak to your broker, whoever you talk to. But I'm here to tell you that Snowflake is definitely in trouble. And I would not be surprised to see Snowflake break below that 208 number. I got to know where the IPO was priced at. I got to know that. It's going to be a deciding factor for me in terms of what's going on. So I'm actually doing a quick Snowflake IPO price. I just got to know. 120. Okay, we're not even close to that. So that's the good news for those who are actually long the stock. So you don't have to worry about that. But the other side of the coin is it definitely. I think it's going to go lower from 208. I see nothing about it. I'm looking at the 10-day moving average. You're running right below the 10-day moving average. The other thing I'm going to do right now before I get off this stock, let me put the Bollinger Bands on it. And Bollinger Bands set for 1 standard deviation. I believe that, yeah, I'm set for 1 standard deviation. That's what I'm set for? Bear with me a second. I just got to check and see what I'm set for. Yeah, I'm set for 1 standard deviation. The reason why I set it for 1 standard deviation is it confirms a trend. And right now, if you look, Snowflake is not, it's still within 2 standard deviations, but it's outside of 1 standard deviation, a lower band, which is confirming to me that that's a confirmation I use. It's confirming that this stock is definitely in a downward trend, and I would expect it to continue. I don't see any reason why it wouldn't. None. Good luck with, Christian, I'm pretty sure that you're short, so good luck with that. Nice trade, good call, way to go. All right, I'm just looking. Any other stocks? By the way, Christian asked me, do I like catching falling knives? The answer is he knows I don't. But I'm going to say this, and hold on a second, I'm closing my Bollinger Bands. I'm going to say this, and please understand what I'm about to say. I'm not bullish to stock. All right, I'm not saying it to buy down here. For those of you who think you might want to buy it here because you're looking for a bounce, this is a perfect place to either buy a call or do a hedge synthetic. All right, this is perfect. This is it. The reason why you want to buy a call is because if you're wrong, the most you can lose is a premium that you buy, or what you paid for the call. A hedge synthetic, again, I haven't gone through the numbers. For those who don't understand hedge synthetic, again, I'm going to send you back to my YouTube channel. I have a video up there about hedge synthetics. If you use a hedge synthetic, make sure that you're lowering your call cost by doing the hedge synthetic. And if you are, add some time to it. So don't go out there and buy a contract. Let's see, we're in this month. Contracts, you probably have some contracts expiring this Friday. Is this the 3rd Friday of the month? So I wouldn't buy a near-term contract. Buy some time. Put 30 days, at least 30 days on that. All right. Wow. Nice call. I know, Christian, I know you're also short, or was short, lemonade. I'm just pulling that up. Woo. I want a daily chart at lemonade. You're right near support here. I would say that support's right around the $89 number. And here's what's interesting about lemonade. And you're still short. Good. Here's what's interesting about lemonade. And Christian, you'll appreciate this. The stock right now has broken below its IPO high that was set the second day of trading. The IPO high the second day of trading was at 96. This stock has broken below that. Now, the reason why I bring up, and let me switch back to a daily chart. The reason why I bring that up is what that tells you is that, follow me now, all these investors that brought this stock, it was hot, it broke out, they brought it, and they never learned or never figured out when to sell. All right. Now that the stock is breaking down back into that old territory, you're going to have some of these people saying, that's it, I'm getting out. I'm not going to hold it. So it's probably going to come under more selling pressure. I would stay short. If anything, Christian, maybe lock in some profits, buy some calls to hedge it, lock in some profits, write some calls, maybe add a little extra income to it. But other than that, I see no reason why to cover. None whatsoever. All right. And then I had SMAR. I can only tell you I can only give you a technical analysis on this because I'm not familiar with the fundamentals at all with the company. So, What's interesting about this is the stock was on my watch list because it IPO'd at $15 a share. And it went basically from 15 up to $30 a share, traded sideways, and then I basically lost interest in it. I'm looking at a weekly chart. So one thing I'm going to say to you is, even on the weekly chart, this stock shows a lot of volatility. And yeah, it's showing a lot of volatility, especially on a weekly chart. The stock was in a trading range between 35, and basically 55 for from June of last year to basically till November of last year. So for those several months, the stock was trading between 35. It finally broke through that 55 number, which was resistance, and it ran from there to $80. And now again, it's pulling back. It's kind of coming back towards support right around 50, $60, some support there. Not sure what to do with that. That's on a weekly chart. Let me switch it to a daily chart, see if I can narrow some stuff down for you, be a little more exact. My connection, okay, my connection got weak. As I look at this thing, wow, hard reading here. Looks like you're right in the middle of a trading range, between 70 and 60. If it breaks through that 70 trading range, there's more resistance at 75. And of course, then you have the other resistance, which is the old high of 85. So I would say you got a lot of work in this stock. There's a lot of work here. If it breaks below that 60, it's going to fall back into that trading range between near-term trading range between 40 and 60. If it holds up and goes up to 70, hopefully it'll push through and break through that 70 and give you the 75. The one thing I can say on this one is it looks like that this stock has a lot of work in front of it. Let's see. And it reported earnings, and the estimate was for a loss of 13 cents, and it reported a loss of 23 cents. So earnings didn't help. I'm not trying to be funny, but earnings didn't help the stock at all. In fact, that's where the sell-off came. When earnings came out, the stock was basically trading at $70, and it sold off to the low of 60 based on them missing a number. Again, my opinion. And again, I believe this is Sasha. My opinion, Sasha. I am not in love with the company. I have nothing to gain by this, win or lose if you buy it or don't buy it or own it. But basically what I'm going to say to you is, looking at this stock, I don't believe in owning growth stocks that miss the number. I just don't believe in that. So without going into too much detail, I'm going to go into this in some future calls. Earnings is a catalyst. A catalyst is something that will either drive the value up. If it's a positive catalyst, it could drive the value down. All right, earnings is a catalyst. Earnings reflect how well a company is doing fundamentally. Earnings come from revenue, work its way down the income statement to net income, and then net income is earnings. And Wall Street uses earnings to value a company. It's one of the top ways that we value companies is using earnings. So when you see negative earnings, when I see a company miss earnings and they're losing money and they miss it, first and foremost, one, I'm not interested. I don't want to be long that stock. Two, if you decide that you want to stay with the stock, my question to you is, why did they miss earnings? And if they missed earnings for a legitimate reason, let's see, the Suez Canal got blocked, their supply chain was delayed in delivering, and that's what hurt earnings. Okay, great. That's out of their control, plus it has nothing to do with the company. It's more of an external event, not a problem. Now, if it's having to do with the company, they're not selling as much, their cost of inventory is going up, whatever the case may be, it's not a good sign if you're long the stock. All right, so if you're long the stock, and especially if you brought it for earnings and it missed the number, there's no reason to stay long the stock. Get out. One of the things, and I'm going to, I got maybe 2 or 3 more minutes, but one of the things I always tell you guys, the reason why you sell a stock is because of the reason why you brought the stock. So if I brought this stock for earnings and it missed the earnings, why am I still in it? Is that making sense? I hope. the reason why you buy a stock is also going to help you have the reason why you're going to sell a stock. So hopefully that works. So hopefully that helps you out a little bit. And that's just my 2 cents for what it's worth. All right, I got I'm about to wrap this up. I don't see any more questions, so I'm going to wrap this up right now. One of the reasons why, again, guys, just so you know, I wrap things up within an hour. It happened to me one time where I went over my hour, and Instagram deleted the whole recording, so I could not put it into my I could not archive it and put it into IGTV. So I make it a point now to make sure that I stay under an hour, so that way I can save this and post it, and you guys can see it and read it. One more time, I'm going to give you my disclaimer. These are my thoughts, my opinions. If you decide to, or you're looking to do anything that I'm talking about, make sure you speak with your financial advisor and get some advice. I am not your financial advisor. I am a Instagram TV host. I'm laughing at myself. I just gave myself some crazy title. All right, guys. Appreciate you. Thanks for stopping by. Feel free to text me or hit me in the IG, on direct message if you have any questions during the week. I usually get back to people right away. Well, I shouldn't say right away. I usually get back to people before the next call, and we talk about these things. Again, I do appreciate you. Have a great, great, great week, and make sure you keep putting money in your pocket. All right, Professor Milligan out. Talk to you guys later. Thank you.